Okay. All right. So I'm starting the meeting recording. So good afternoon and welcome to today's session on time value of money, CAGR, compound annual growth rate, perpetuity, and discounting. So the concept is what you are seeing on the screen, but I want to ask us some questions before I go into trying to influence your answers. So if you go on the link that I've shared, I'm going to show the link. If you go on that link that I've shared, I want you to please answer the question. You can also go to www.menti.com and use the code that you are seeing on the screen. So any of the two options you like, either you use the link that I'm sharing. I've shared the link a second time. You use the same link. Use the same link to answer the question. So I would like to see your questions pop up on my screen. So use the same link to answer the question. At the same time, okay. Someone, okay. So what comes to your mind when you hear time value of money? And also it would be nice if anybody wants to also speak. There is a whole lot of category of audiences we have. So I posted this in so many places that I know that there will be people who are joining us who do not have finance background or accounting background. If anybody also wants to unmute and say something, to be very cool to hear a different voice from mine. Okay, so what comes to your mind when you hear time value of money? Money that I have now is far better than same future amounts due to inflation. Nice. There's a question I have a trap that I set in the future in the next couple of slides. Maybe I shouldn't call it a trap so that you won't be confused. Okay. Any more people want to share theirs before I move to the next question? And anybody want to also, maybe say it, word it out. It would be nice to hear. Okay. So I'm going to move to the next question since you've all refused to say any extra thing. So the amount you earn after saving the money for a certain time of years. Okay. So here is the next question. Okay, so this one requires you to vote. Let me see if the voting is open. Okay, yeah. So yes. Pick your answer. So what is the major underlying factor of time value of money? Is it inflation? Is it interest rate? Is it exchange rate? Is it dividends? Okay. It would be nice to hear our answer, our opinions. Yeah. Let's quickly plug in our answers. Dividend. That's a nice one. Okay. If you are just coming in and you don't know where to go to be able to answer this question, no problem. Just go to www.menti.com. You see it on your screen. Enter the code 85491527. It takes you straight here. So I'm hoping to get more responses. Exchange rates. These are really interesting answers. Okay. So what for you, it's because I think maybe I personalize it, but anyway, what's the major underlying factor of time value of money? Okay. Two people say inflation, one person say exchange rate, another person say dividend. Okay. So that I can move on, I would like to see maybe two more answers since we're about, how many are we in this session right now? I think we're about 12, right? Occurring twice. No, we are 13. So there is me and 13 other people in the house. One person has chosen interest rate. Two more people have chosen, one more person has chosen dividend. Okay. All right. I'm going to close the voting in how many seconds? I think I'm supposed to in 30 seconds. The voting is going to end in 30 seconds. So your last chance to participate is running out. How do they say it in a football commentary? Okay. So once about 30 more seconds is over. You'll be able to vote again. So now is the time for you to hear your opinion. Okay. All right. So 3, 2, 1. Ta-da. Okay. Finally, why would you want to receive $10,000 today rather than the same $10,000 next year or in 5 years' time? So now, have you seen the trap? Those of you who said exchange rates, at least this is $10,000, right? It's not Naira. So I want to know how you're going to justify why you would rather receive a $10,000 today rather than the same $10,000 in next year or in 5 years' time. Okay, so please plug in your answer. Yeah, it's open for. So yes, I would like to hear your opinions. Why? If you also want to unmute and speak, it would be nice to hear someone say one or two things. It's not just by typing. Though it would be cool if you type so that everybody sees your answer, and it makes it a lot faster for responses to stream in. So this is the last question. Once you answer this question, I'm going to now go. The interest rate may be different. I'm scratching my head. I don't know how to interpret that one. $10,000 today won't be $10,000 in 10 years. What the money can purchase in 10 years will be lower than today. Yeah, I've changed my question. I didn't say 10 years, but I get the underlying concept. Okay, let's maybe hear 2 more people. Anybody wants to say something? Let me see if I can call some people I know. Dr. Francis, let's hear from you now. Dr. Francis, Mr. Akim. Yeah, Madam Aisha also,
Hello.
Yeah?
Hello.
Yeah.
Okay, so basically, why would I want to hold 10,000 today? Okay, there are several factors, okay, you need to take into consideration. So one is that you look at the opportunity costs. Okay, instead of me holding that 10,000, I may have other opportunity to use it today. Well, inflation may also be there, but most importantly is the risk factors, because we don't know what will happen tomorrow. So it's just better give me the money now. If I have any other opportunity, I can put the money in there. So I think those basic 3 factors will drive your decision to hold the money today.
Great. Mr. Akim, I also like to hear your own thoughts.
Yeah, I've responded. I said $10,000 today. What more than $10,000 in the future?
Okay. And you don't want to add any more things to what?
Yes, why it's more? Because if what the price you bought today, you can't compare it to what you will buy in the next future because of inflation and the situation of the things, maybe later in the future.
Okay, great. Madam Aisha, Madam Miriam, any opinion? Okay, so at least I've gotten about, let me count, 8 different responses. Let's say 9 plus Francis who aired his own out. So thank you very, very much. And with that, I'm going to now close the voting. Right, and that's the last question actually. So if I circle back, okay, now when we hear time value of money, yes, future value discounting, but actually when it comes to making decision with time value of money, there is only one very critical factor. So that's the next question that I asked. And interestingly, that's the fewest number of people picked anyway. So it's interest rate, to be direct to the answer. So interest rate is the major. Yes, there are many underlying factors, but the major one is interest rate. I'm going to explain how anyway. And then also we are all correct. I just wanted to throw in this one because I know some people will pick exchange rate. So I wanted them to now like, okay, if it's exchange rate, then I wouldn't consider any difference between a $10,000 today and 10,000 next year. So that was the main reason why, and then just to hear what other people will say. So let's go into it right now and then begin to think about it as it relates to you making financial decisions. Okay, so I am going to go to, I have created a Google Sheet that I'm going to share right now. And so the reason why I'm sharing the Google Sheet is anything I do, you'll be able to also follow without you asking me for the link again. So I have decided that what we're going to do, I'm starting from scratch. Starting from scratch means that I'm not going to cook up the examples I had and just be walking you through what I've done. We will build them together. So the worksheet for today, today's session is, so I know there are people who joined us based on what I said about, even if you do not have finance background, this is something you should be aware of. So if you are joining because of that, please, if you see me saying things that you do not understand, or if you think I'm going too fast, indicate. I'm able to see on the chat message. You can also unmute yourself and talk. There's no worry of you disturbing me. It's like a class. If a lecturer is talking, or a teacher, or whatever grammar you want to use for who is in front talking, you can also talk without it looking like you are interrupting the class or like you are creating noise. It's the same way too on Teams. So just imagine that you're having a class session and something is looking a bit tricky for you and you want the person to address it. Yes, feel free to. So now that I've gotten that out of the way, let's start with what actually time value of money really means, right? Time value of money, we are all correct, but then there is something a lot more important than, not everything carries the same weight anyway. So time value of money is actually hinged on the fact that you can earn interest, an interest that compounds on money over time. So time value of money is hinged on the fact that you can earn interest, a compounding interest rate on money over time. Why interest rates? Why interest rates? Why not inflation? Why not, what's the other things that I put in the exchange rates? Why not dividends? I would like to know why those who chose dividends said dividends anyway. Why not dividends? What's the other thing? I think these are the other three things I put in there. So why not inflation? The truth is this: inflation is a very vague term. It's a very vague term. Even though we all agree with the fact that there is a measurement, but that measurement is never reflective of any one single thing. It's a basket that is always being disputed. So inflation is a vague term. The moment you go into financial calculations, you need much more specific and non-disputed figures, right? So that's my way of explaining why interest rates, minus me saying it, actually, if you search for time value of money, all definitions always hint on interest rate. So I'm just trying to explain why. Remember I said I'm going to explain from a concept that all of us can understand. Any textbook you pick, any website that is dependable that you go through, that's just it. It always hints to, let's see, it always hints to interest rates. But let me not keep repeating myself. Let me try to just help you grasp why I think interest rate is what is linked to rather than the other factors. So the moment you want to go into calculations, right? The moment you want to go into planning, you need something that much more specific and not disputed figures. If you are going to buy things today because of inflation rates, right? The funny thing is, do you know that the price of, even in Nigeria, the price of phone calls are dropping, right? Versus many other things that we buy, right? So that one is actually deflating, not inflating, right? And also too, everything is not rising at the same rate. So if you are going to give up on, if you're going to say, okay, this 10,000 naira now is worth more next year, right? Everybody agrees, but how much more what? Like, how much is the work? Quantifying the more is going to be very problematic if you do not have specific figures. How are you going to, okay, yes, it's worth more tomorrow, but then in deciding what to put the money in, how are you then going to decide whether to put it here in opportunity A or opportunity B if you can't even decide for yourself, you know, what is the more? How will you estimate which is more? So, okay, yes, everything goes up in price because of inflation. Are you going to invest in land versus are you going to invest in stocks? You're going to see that if you do not have something much more concrete in deciding, in making your calculations, that hinging it on something like inflation is going to get you nowhere. Absolutely. Then exchange rate, that one is even worse because it is both ways. If you say naira against dollar, then what will you say about those in US, those using dollars? So if you're going to say euro, so you see that exchange rate is never going to cut it because it's not going to be universal. It's either it's worth more for everybody or it's not worth more for you. The moment you start picking exchange, it means it to be worth more for some people, and some people it won't have any effect since they are in the stronger currency. Then dividend, that one too is very funny because dividend has two things tied to it. What the decision by the company to even give dividend, you know, so that the company is profitable does not mean they will give dividend. They can decide that they want to put back all their money into operations and not give. So that one is having an uncontrollable factor in it that makes it not also useful for planning. So now that I've mentioned all of that, the real thing that time value of money says is if I have money today, no matter the value, right? Today, I have options. So Dr. Francis, what he mentioned is the very perfect word for it. I have options. I have opportunities to grow that money. Different opportunities, right? So I can start listing out the opportunities. I can put the money in, you know, let's start with risk-free. In a risk-free investment. Yes, people will argue that no investment is risk-free, and also at the same time, yes, we all unanimously agree that if you invest in government bonds in same currency, it is technically risk-free. Government can always print money to pay their own bonds. So, you know, yes, you will suffer it in terms of inflation, but you will get whatever they have promised you. You know, so you can't. Everybody agrees this too. That yes, nothing is really risk-free, but also investing in government same currency is as close to risk-free as you can get. Okay, so if I know I can get 6% per year, if I get 6% annual rate return from government treasury bills or whatever it is you want to invest in, or bonds, whichever one. Let me just keep it at the 1 year one. If I can get this, right, then what that means is that if I have 10,000 naira, let's even make it a bigger amount of money. Let's say I have 1 million. If I have 1 million naira today, right, then exactly 1 year after, exactly 1 year after means today is 2021, 2022, I'm going to have, what is 6% of 1 million naira? I'm going to have, that will be, in fact, let me use a figure that is easy for me to calculate. Say 100 million naira. So that's going to be 106 million naira. So what does that mean? It means that, you know, without me sweating, without me doing anything out of the ordinary, right? If I put in my 100 million naira in government treasury bills, 1 year bill with a return rate of 6%, I'm going to have exactly 106 million naira next year. I can go on with my life. I don't have to pursue the government. I don't have to do any work. I don't have to visit the farm. I don't have to sweat anything. I just move on with my life and the money comes in, right? So what that means is, if you want to give me money in the future, if you want to give me, I'm going to drag all this. So if you want to give me 1 million naira next year, right? Today, which is 2021, that 100 million naira you want to give me next year is not, to me, is not going to be the same as 100 million naira today. Why? I know that I can earn this amount. So what that means is that, I think, okay, sorry, I don't know what happened to my connection. And I am using the same internet, 2 different devices. The one with my mic on went off. So please, can you just notify me that you can hear me and you can still see my screen? Can you all still hear me and see my screen? Hello, can you all hear me and see my screen?
I can hear you and I can see your screen.
Okay, great, thanks. Okay, great. So back to this. If I know the money that you want to give me next year, how then do I calculate what the value is today? So that brings us to the next important thing, discounting. Let me start with discounting. So discounting is the thing that helps us to say, how do we compare money that are coming in at 2 different time periods? So we have what we call discount rate. So discount rate is, in this case of this example now, this 6% can be my discount rate. If I know that that is the amount that I'm happy to collect. So it's a measure of, an option of, you can choose between rates you are certain to get or rates you are happy to get. So it's one of those two actually. So rate you are starting to get or rate you are happy to get. Rate you are starting to get is as if you saying risk-free rate. Whereas rate you are happy to get is what we call expected rates. So we're going to talk about the two later, but let's start with rates you are starting to get. So if I start with rate I'm starting to get, then I can take the discount rate at 6% as the rate, you know, that, let me just call it risk-free rate. Then we will gradually move on to the other one. Okay, so the formula says that if I know my discount rate, then I can get the factor by which to discount the future amount. So that future amount is what we call FV, future value. So you can see how I am beginning to bring in all these terminologies you come across when you open a finance book. So I can use the discount amount to discount the future value, the future amount, to today's value, which is a PV, present value. And all these things that I'm saying, I'm going to help you understand how you apply them in reality. I apply them a lot. You know, they are not very distant. They are not things that are textbook definitions and sit there in the textbook alone. They are things that when you understand them thoroughly, you begin to apply them a lot more in your day-to-day life. So the formula is not difficult. You probably even already know the formula. It's just that maybe you never thought about it this way. So the discount factor formula is equal to 1 divided by 1 plus the rates. So if I use R as the rate, okay, then raised to power the number of periods. So I can use T as the period, okay. So this is that. Unfortunately, I cannot write on, let me see if I can insert a function. Insert function, okay, great. Insert a financial equation. Insert equation. If this was Excel, I could have been able to insert equation, but you get it anyway. So now that I've written this formula, right, I can use that to find what this will be. So what this means is that I have a future value of 100 million naira. I have rates, discount rates, of 6%, right? What other thing do I have? I have time or period. This period is more agnostic. Period T into the future, period into the future. Let me say it that way, of 1, because you know 2022 is one period, 1 year away from now. Okay, so discount rate per period. Anyway, always ensure that your rate and period agrees. Ensure that rates and period agrees. Agrees means if you are using an annual rate, then your period will be in years. If you are using monthly rate, then your period will be in months. Okay, so with that, I can calculate what my present value will be. So my present value is going to be equal to, I need to first get the discount factor, the amount by which I'm going to discount the future value. So discount factor, as I've shown us, is going to be equal to 1 divided into bracket 1 plus the rates, the discount rates, raised to power the T. The T is this period, and that is it. So it tells me that that money that you want to give me in the future, I have to discount it by this factor. Discount it by this factor of. So this is the actual money you are giving me. You know, I'm I'm not so very used to this is okay. I'm not so very used to formatting in Google Sheet, but this is it. Okay. Now you'll be like, Michael, this is head twisting. Don't worry. See, just remember that when this was 100 million this year, we were able to, without any problem, we were able to know that 6% means I will get 106 million, right? See how our formula is going to give us that again. So if I type 106 million here, 1, 2, 3, 1, 2, 3, you will see how I'm going to get exactly 100 million back. Okay, so now what I've just explained to us is the fact that money today is valuable more than money tomorrow or next year because I can earn interest rates. And why are we focusing on interest rate and not inflation and not all of those? Why? Interest rate is the thing that I can go and search for and get the value for. Inflation, if you buy a land, how do you know rate at which land inflates? You are never going to use the normal inflation rate. That normal inflation rate is a basket of inflation, so it's useless to you for calculation. Why? Because if you buy a land, except you want to go and buy exactly what is in that basket. You know, when I say basket, what government uses, and me, I don't trust Nigerian government. Me, I think they do stuff to that number. That number is not really genuine. But anyway, let's put that aside, right? Nobody goes to buy exactly the basket. You know, you're not going to go and buy some tomato, some chairs. So when I say chair now, chair and tables, some, you know, all those things they put together to now say, this is the basket of, this is the basket that we are using to compute inflation. And you are not even probably going to be using it the way they are computing. So it is too distant to reality for your own calculation. So that's why you will not use it. Exchange rate, if you use exchange rate, it means the other guy on the other side should not have time value of money because, yeah, well, Naira is going, you are using Naira as the base. The person spending dollar, then a dollar today and a dollar next year will not be different for him, but we all know it's going to be different for him. So that is also out of the window, out of the options. Dividend, the management of whoever is gives you in the dividend can decide not to issue a dividend for whatsoever reasons that does not tie to anything economic or anything strategic or anything useful for you or anything valuable for you. But interest rate, yes, interest rate, you can always get the figure. If I give you $1 million today, you can go to the bank and negotiate a rate for fixed deposit and it's going to come. So that is the value that you can get a specific, when it comes to financial calculation, that's the thing you can get a specific value for. So that's why I personally believe when we talk about time value of money, it is hinged to that. But then if you throw away my own personal explanation and beliefs, if you go and search all textbook definition and all, it is always hinged to interest rates. So I'm just trying to give a practical explanation to why it is hinged to interest rate. So now that that is out of the way picture, you should be clear with me on that. The other thing I'm now explaining is, so how do we practically play this out? So I started with the rate that you can get. So I said you can always bank on government honoring whatsoever the rate they have promised you when you buy government treasury bills or bonds in their own currency. Everybody technically agrees that the government will never default on their own loans in their own currency. They can default on loans issued in another currency, but they cannot default on their own loans issued in their own currency. Why? They have the printing press. They will just print more money. That's it. You will suffer it in inflation if it gets really worse, but they will never really hold you because they will just print more Naira and give to everybody, and that's it. You got what you are promised. So that is what we call risk-free rate. That's the closest to risk-free rate. And so if for you, you have zero appetite for risk, then that is the rate you are starting to get. So anybody trying to get your money today and give you back money tomorrow, they must be able to match it. Otherwise, it makes no sense for you. Okay, so that is what brings us to how then can I calculate the money you want to give me tomorrow? The money you want to give me tomorrow, how can I calculate it in today's value? That brings us to time value of money. So now I want to go to another thing, right? I hope we are clear with what I've said. I'm still going to explain the one about the rate you are happy to get. I've just talked about the rates, risk-free rate. What about expected rate? We'll talk about it. But before I go to that one, how do you know the rate that is applied? So how do you know if somebody promises you, if I come to you today and say, let me look for someone's name here, and say, Uche, you know what, give me that 100,000 naira that you are not intending to use for now, that bonus you collected at office today, give it to me, and in year 2024, I'm going to give you back 160,000 naira. So this is 3 years. So if we come back here, this is a case of, I'm going to give you a future value of 160,000 naira. All right? You are going to give me a money today of 100,000 naira, right? And then the period T is 3 years. 2024 minus 2021. Yeah, that's 3 years, right? So the question now is, what is the rate? What is the rate? That is the question. Anybody want to know how we could have calculated this? Or anybody have an idea of how we could have calculated this? And let's start with, do you have an idea, of how we can? Why do I want to know the rate? This is the only way I will know. The annual rate, that 6% is an annual rate that I said I can get risk-free. So I want to know, right? Does the annual rate of this your business that you are wanting to collect my money and give me back 160,000 naira in 3 years, does it beat this annual rate? I cannot just come and look at it this way and say, oh, you're going to give me 60%. 60% is 3 years, right? No, and I cannot divide the 60%, because this looks like 60% if you think about it. If somebody gives you 160 naira for 100 naira, that's like they've given you 60% return, right? But this is over 3 years. And I cannot divide the 60% by 3 because we are talking about compound interest. Compound interest is not simple interest. The money that you give me next year is going to be the basis for the interest next year, right? So it's no longer arithmetic, right? So whatever we are using has to factor in that the money is compounding yearly, right? So I want to ask you, how do we get these rates?
Hello.
Yes.
Yeah, to get the rates is just to use the rate function on Excel.
Okay.
When you use rate function, you'll be able to use the future value, present value, and the numbers of the tenor, which is 3 years, to get the rate. Excel will automatically calculate it and give us the rates.
Okay, nice. Anybody want to also chip in? Anybody has a different idea or opinion? Okay. Thank you very much. And we're going to try what you've said. And I'm also going to say what I have in mind. So we'll do everything that everybody brings into this conversation. So before I go about typing formula, right? What we're effectively looking for is what we call the compound annual growth rates, CAGR. So what is that annually compounding growth rates? That is just like you're an entrepreneur, right? You started your business in year 2015. In that year 2015, you're an entrepreneur, you started your business in year 2015. In that year 2015, your revenue was 100,000 naira. Now, you are in year let's say year 2016, your revenue was 120,000 naira. In year 28, let me just keep up the sequence instead of typing again and again. I think, yeah, great. So your revenue was 180,000 now, 250,000 now, 400,000 now, and then now it's 1 million. Now, when you're talking to an investor, right, are you going to be saying, oh, we grew what did I do now? Okay, I need to undo what I've done. Okay, good. So when you're talking, wow, so I left a whole lot of blank spaces. I didn't know. Let me just delete these ones. Great. So when you're talking to an investor, are you going to be saying, oh, Mr. Investor, we grew, you know how to calculate growth rate now. Last year, this year divided by last year minus 1. I make it percentage. Oh, Mr. Investor, we grew 20%. Maybe I should have just put this one back here. We grew 20% in year 2016. We grew 50% in year 2018. We grew, you're giving the man headache. Can't you just say, oh, from inception, we grew at an annual compounding growth rate of X. So that annual compounding growth rate of X is something very similar to what is our 2020 revenue, which is this amount, right? What was the revenue when we started? Revenue when we started was this amount, right? So number of periods, that is equal to this year minus this year, right? So that's 5. So we now want to find what is our growth rate, which I have told you is CAGR. So what's that our compounding annual growth rate? So what rate have we been growing in our business, you know, these last couple of years? And that's what I want to tell you as an investor and say, oh, since inception, we have grown at an annually compounding growth rate of X. Okay, so this annually compounding growth rate, there's a formula for it. Now let's start with what, who gave us that one? I think Mr. Temitope. Yeah, so let's start with what Mr. Temitope said about using a formula called rate. So I'm going to start, and let's hope it's also here in Google Sheets. Okay, so good, it's also here in Google Sheet. So payment per period. Are we receiving any payment per period? Present value, we have present value. Future value, yes, we have future value. So there is an issue with you using rates. If you use rates, it makes it look like you are trying to work backwards on a loan calculation. So I give you a loan and I say, oh, you are going to be repaying, maybe I borrow you 10 million naira and I say, oh, this loan is over 3 years. You're going to be paying me back, you know, 3.33 million naira every year, plus interest. So maybe plus interest of, I don't know, maybe 500 million, 500,000. So maybe you'll be paying me back 3.8 million every year. So with that amount, or you want to buy a car, and the car is 5 million naira, or you want to buy a land and it's 5 million, and I say, oh, you know what, you can spread it over 3 years, but when they spread it or over 4 years, let's even say over 5 years, so it's easy, 5 million naira over 5 years. Ordinarily, you would think that would be 1 million naira you'll be paying, but somebody that has business sense is not going to let you pay 1 million naira every year for 5 years. He was going to maybe say you pay 1.1 or 1.2, such that when you multiply it, you know, 1.2 times 5 is going to be like you are paying 6 million instead of 5 million, right? So when you look at that, you want to say, okay, at what rate, what interest rate has this person computed for me? So rate does that for us. Unfortunately, this is not that type of situation. There is no periodic payment coming out of this. This is just simply future value, present value. There is no PMT. The same thing if I bring up Excel, is the very same situation you will see. Let me just copy those values and dump it on an Excel sheet, and let's try and use the same formula again, rate. and you will see that what I said is exactly still the same thing you will come across. Rates, right? Rates. Let's even go here and bring out FX, and if I zoom my screen, you're going to see that that's what is going to ask us. Number of periods, yes, we know it's 3 years, but again, it's going to ask me payment. And can you see payment is amount made each period and does not change. It's a consistent amount made each period. So that's where rate fails us. Rate is not going to do this for us because rate does not allow for just start of period, present value, future value, which is end of period, and time. You need a formula that allows you to just plug in only these three without you having to say there's a periodic payment. So that formula, wait for it, is called RRI. So equal to RRI. Can you see? Returns an equivalent interest rate for the growth of an investment. Okay, so if I do this, right, you'll see it will ask me for the, can you see it asks me just exactly for those three things that I have. The period, which is T, the present value, which is the money at the beginning, and the future value, the money at the end, and that's it. With this information, I'm going to get exactly how much the rate of return is. And if you think about this, right, if you think about this, it is exactly what would have played out if I was computing this manually. If I was computing this manually and saying 2021, and I'm going to drag this up until 22, 23, 24, right? And I use this growth rate, which is going to be, this times into bracket 1 plus this rate. So that's how you factor out growth. If it's 10%, it will be 1 plus 0.1. That's 1.1 times 1 million, that's 110. So that's the normal way of calculating how much something grows, right? So if I do this, and I keep doing it again and again, and I drag it, you will see that I'm going to get 3 years is what? Oh, that means this is 4 years actually. Okay, 2021, sorry, 2021, 2022. Yeah, so this is that. Good, so it stops here. So you see that I get exactly that figure, right? And it's the same concept too with this one. So if you are an entrepreneur, you have a business, right? And in your business, you need to just tell the investor, this is how much your business has been growing in the last 5, 10, whatever number of years, without overwhelming the investor with, oh, we grow 2% this year, we grow. Over the last 10 years, this is how much we have grown, right? It's the same formula, the same RRI formula, right? So take a look at it. Equal to, so the CAGR is equal to RRI. Okay. Let me zoom so you see my screen. The number of periods is going to be the current year minus when we started our operations. So then the present value was our first revenue. The future value is our current revenue. And with this, it will tell me, oh, we've been actually growing at a cumulative or a compound annual growth rate of let me put it in percentage, of 58%. So this is much better. This is much better. This is what, if you are creating an investment pitch, this is what you want to put. Oh, we've been growing at a annual growth rate of 58%. Not that you are going to start doing a overwhelming the investor with, oh, 20%, 50%. Can't you just normalize the growth rate and let them know what it is you've been growing at? And how can we?
What of if we do the average of those growth rate, those each year growth? Will it give us 50%?
So average of those of the growths. So average of all these growths that we have calculated, this 20%, blah blah blah, it's giving us 63. So let us check which one is correct. The one we use CAGR for or the one we use average for. So we're going to work backward. So in the first year, right? So this. So in the first, in fact, let me just copy all of this and paste here, right? So if you use, let's see which one will get us this value at the end. Equal to this times into bracket 1 plus these growth rates, okay? Then equal to this times 1 plus these growth rates, right? And I drag all of them. Can you see that it's only this one that got us the exact? Okay, so I hope with this approach, I've been able to explain to us CAGR. So we just finished explaining CAGR, cumulative annual growth rate. Okay,
Yes.
so
Thank you.
You're welcome, sir. All right, so the next one is perpetuity and discounting. I'm going to do them together. First of all, imagine that you are the kind of investor that for you, 6% is okay. 6% is fine for you. That 6% annual rate is perfect for you. Now, what did I say? That there are two options. There is the one you are certain of. 6% might be fine because you are certain of it. But then what if you are not certain of it? What do I mean by what if you are not certain of it? If I come to you and I say, let's go into farming and that we're going to get a return, I don't think you will be happy with 6%. Why? You're going to put in effort. You will be monitoring me, even if you are going to be passive. You have to be, it takes stress. Your BP will not be the same as if you put all your life savings. Maybe you have 100 million life savings. You put it in government bills. You will not have high BP versus if you give me that 100 million, and then I go into farming with it. Your BP will go up small, right? So that your BP going up. The only way you will be okay with it, and that's even if you are the kind of person that enjoys risk, is if there's what we call expected return. So expected return is equal to risk-free rate plus a premium. So you're going to be demanding a risk premium. The only reason I'm going to put my money into this is that it's going to give me a lot more than what that 6% that I could have gotten by putting my money in treasury bills, right? And so that risk premium is plus risk-free rate is what we call expected return. There are so many ways to calculate it. There's CAPM, which says is equal to risk-free rate plus beta into market return minus risk-free rates. So there are many ways. There is a APT, which says risk-free rate, arbitrage price interval. It's a risk-free rate plus, all kinds of other premium. So beta 1, factor 1, risk factor 1 premium. So like those of us in Nigeria, you can say, okay, our political instability is one factor, you're going to demand a premium for it. Our exchange rate is another factor, you're going to demand a premium for it. Beta 2, risk factor 2 premium. So it doesn't end anyway. So these are the two major ways, but those are formulas that in the end, people just choose a figure they are okay with. Somebody can say, I'm only going to, that's what most people say when you see them talking groups. They say, I'm never going to invest in anything that will give me less than 20%. The moment you say that, that 20% becomes your expected return. So are you now clear about what I mean by expected return? So whenever someone says my cutoff, if you come to me today and say you have an investment opportunity, the first question I will ask you is what's the rate of return? If anything you tell me is less than 20%, I'm not doing. So that means that is my expected rate of return. So now let's talk about perpetuity, right? So what perpetuity says is if I have an investment, so here the investment return, the investment annual income. In fact, let's call this year 1, year 2, year 3, year 4, like that. So I'm going to do this. So this is what we will end with anyway. So I'm going to drag this a considerable number of rows. Okay. So now, if you come to me and you say there is an investment that you want me to put money in, and this investment is going to be giving us annual income of 2 million naira. How am I going to value that investment? An investment that will be giving me annual income of 2 million naira, how will I value it? Can you think of an investment that normally gives this type of return? Because of time, I will pause. Most real estate investments are like this. If you buy a house just for you to rent it out, you know, usually it's this type. You know, you'll be getting annual rental income. So how then do you value it? So if I know that I'm going to be getting 2 million naira rent every year, then what is the value in today? What is the value today? Value today of an investment that pays me yearly, forever, perpetually. Perpetually. So you see why we call it perpetuity. Perpetuity. I kind of twist tongue when I'm pronouncing it. So, ladies and gentlemen, welcome to perpetuity. There's a formula for it. Very easy formula. Simply just says the annual income divided by the rates. Remember what I said? The rate can be the expected rates, can be risk rates. So if you are expecting a 20% return on your investment, right? Then the value of the business, the value of, if you use the perpetuity formula, then today's value or present value, remember I've told us today's value means present value, is equal to that 2 million, 1, 2, 3, 4, 5, 6, divided by this, divided by this. Many people used to see this as magic when I prove it to them. But let's see it. It says that you should not be willing to pay more than, what's this? Let's remove the decimal. You should not be willing to pay more than 10 million naira for the house. So it means you should buy the house for 10 million naira if you're expecting a 20% rate of return. Now let's see how that is the same if I'm calculating it manually. Okay. If I'm calculating it manually, am I not saying the present value is equal to, right, this investment income times the factor now, times 1 divided by, into bracket 1, plus the rate of return. I'm going to lock that one, raised to power the period, right? Is that not what we are saying? Is that not what we have discussed here? This discount factor 1 all over 1 plus r raised to power t. Okay, so if I do exactly that, so if that's the formula I type here, so if that's the formula I type, right, and I drag it down, yes, drag it down, thing is nice. If I sum it up, let's go and sum it up now. If I come here and I sum up all those amounts, voila, can you see the magic? It's exactly giving me 10 million naira. So instead of me doing all this long calculation, I can always use the formula, that perpetuity formula. So that's perpetuity formula. It says if you know what something will be giving you every year, then without you doing all this breakdown, you can get what the value is today. So if I want to buy into a property that will give me 2 million every year and my expected return rate is 20%, I should not be willing to pay more than 10,000 naira. So this is why some people say it might not be as profitable to buy a house for income, rental income. What do I mean? Most people don't earn more than 5%. You know, you buy a property for 40, in fact, some people even earn less, maybe like 3%. You buy a property for 66 million naira and then you are collecting 2 million naira rent. But anyway, that's just to let you understand. But then the other key thing is, what if the rent does not change? I mean, does not remain static. You are able to increase your rent at a particular, maybe you're able to increase rent 5% year on year. So you collect 2 million this year, you collect 2.01 million next year. So how do we do that? Okay, so that one is called growing perpetuity. Our time is up, right? Maybe we'll do that one next week. So maybe we'll do growing perpetuity and some other things next week so that I stop here. But any questions so far? Any questions on what we have done? Okay, so I hope I've been able to explain to us time value of money, and not just explain it, but help you to understand it in a much more practical way. The bottom line is what Francis mentioned, is opportunity cost. Usually, you can always put your money somewhere. If you are even the kind of person that you are not knowledgeable on all these financial investment, you can go to your bank and say, I want to do fixed deposits. And you know the bank will give you back your money with interest. So that's an opportunity that, you know, if the person is not giving your money today and he says he'll give you next year, that's an opportunity you are foregoing, an opportunity to earn a fixed income interest on your money. So when you know that, automatically money today is never going to be the same as money next year. Why? Money next year is going to be more in terms of you could have earned a money on top of it. That is certain. So thank you very, very much. If there are no questions, maybe I should ask again, any question or any comment by anyone before I round up the session?
Yeah, thank you for your time. Really
Okay, you're welcome. So Augustine is saying, if the remaining topic won't take too long, can we continue? Actually, I've done what I want, but let me just show us the growing perpetuity. So the growing perpetuity is assuming this money will be growing. Assuming this money will be growing at 5%. So assuming this money will be growing at 5% above. So growing rental growth or income growth rate, rental growth, let me just call it. So your rental income will be growing at 5%, right? So what does 5% growing at means? It means that, you know, whatever you charged last year, you're going to charge 5% growth. Like your new rent next year is going to be factoring in a 5% growth. Okay, so are you seeing? So your rent next year will grow, blah, blah. And if I do it like that and do it all the way down, I need to now drag this down. Okay, so if I do like this, then how are we going to value the money? Okay, so how are we going to value the money? How are we going? So we said 20% the other time, right? Let's still do the 20% we did the other time. So that one was, when it was not growing, it was 10. But when it's growing, right, how are we going to calculate the figure, right? So when it's growing, you can see this one says it's 13. If you do the summation here, 13 million naira, right? So what formula could have done it for us? Growing perpetuity. Growing perpetuity. So growing perpetuity says your value today is equal to the annual income, right? Divided by, but that annual income is growing. So that's why we're going to say divided by the discount rate minus the growth rate. Discount rate, which is R, minus the growth rate G. So the growth rate of your income. So if I do that, it's going to equal to this annual income divided by this one minus this one. Like magic. Are you not seeing it giving me exactly that same amount? So that's the cool thing about all these mathematics. The thing you will be bringing your calculator and racking your head around, you know, and doing and summing up all of these. You know, me knowing this formula, I get it like just instantly. So that was what I wanted to show us, that even when your money is growing, your dividend is growing, your whatever it is growing, there's also a formula to estimate the value. So if you also are doing real estate and you're like, oh, I want to know how much, for you you're okay with 12% return, then this will tell you that you should not pay more than 28,571 naira for the rental property to buy that property. The moment you pay more than this, your rate of return is already less than 12%. So those are the things anyway. So thank you very, very much, and see you again next week.
Sorry, I have a question.
Yes, sir.
So what if the annual income is growing every 5 years, not every year this time?
Good.
Any formula that can...
If it's growing every 5 years, the truth is there is no one formula like this. You might have to now do all this kind of breakdown. But what most people do is we use the CAGR. So if it's growing every 5 years, we break it down into annual growth rates. So if I know something is growing every 5 years at 5%, almost like we all know that for bank, they will tell you that, yeah, they will pay you whatever it is, maybe 3% annual return on your savings account. But you know what? They pay you every month. So what have they done? That 3%, they have divided it by 12 months. So if I know it's growing 5% 5 years, I'll divide it by 5 years to bring it down to a yearly one that this my formula can easily work with. Okay, so it's just a way to, you just have to find a way to bring it down to something that makes it even out. So, and that's the truth. Most rent, it's not every year you can be increasing your rent. That's not the truth. Your tenants will fight you. You just increased it last year. So most landlords, they space it. So they will collect the same amount for the next 5 years. They will now just take it up by a big amount, maybe 10% or 20%. And then if you complain, they'll be like, we've not been paying 5% the same amount for the last 5 years. You want to compare what you used to buy rice, buy beans, buy gari at 5 years ago. Even our exchange rate, that's what most investors do. They know that our exchange rate will stay the same for like, before people used to take it for 5 years. Now I don't know if people will take it for 5 years. They say it stays the same for about 5 to 7 years. Then one day it will just boom, jump, you know. All those the same it has been staying, it will now, you know, make up for that flatness by just jumping crazy high, and it's very worrying. So, but that's what sometimes you will do. Great. So thank you very, very much. And at the absence of any question, yeah, Mr. Augustine, thanks also for thanking me. So what's the topic for next week? I don't know. Do you have any suggestion for us? If you have a suggestion, it would be nice, but I really don't know. Except we have a guest speaker, and we are looking for guest speakers. To be frank with us, I'm getting tired of being the only one presenting on our, because if I show you the agenda sheet, if I show you the agenda sheet, we have speakers for every other session, and it's just, see, can you see the financial one? No speakers. Today now we have someone from Canada for the Excel. We have MVP Ahmed for, so we have people for pretty much everyone, but for the financial modeling one, we've been struggling to get presenters. So that's why I've been doing it, because we give priority to external presenters before our own, but it is what it is anyway. So if you have someone in mind, if you want to volunteer or connect us with someone to reach out to, we'll be happy. You can, email us your referral or your speaker referral at webinar.UrBizEdge.com. So if you email us or even call me or WhatsApp me or your speaker recommendation, we'll be happy. We'll be able to follow up and then get a diverse. It won't just be me every week. By now you should be getting tired of me. Even me now, I'm getting tired of myself. So thank you very, very much once again, and see you next week. If you are interested in the coming up Excel session, let me show you where that one is. So the Excel session is, this is it. So we have George Mount, and he's going to be presenting on advancing into analytics. So if you're interested, let me quickly grab for you the joining link. The Excel session at 4 p.m. in less than an hour. So to be nice, and so once again, bye. Have a nice week ahead. Okay. So bye-bye. See you next week.
Bye. Bye.